Hi, everybody. It's Economics Matters, the podcast. I'm delighted to have Allan Roth with me today as my guest. Allan is the founder of Wealth Logic LLC. He's an hourly based financial planner. It's an hourly based financial planning and investment advisory firm that's Wealth Logic LLC. We should really stop right there in this description of his bio because virtually nobody charges on an hourly basis. This is about as honest a way of providing financial advice and investment advice as it gets, because you're not charging for selling a particular product, a commission, so you're not conflicted there, nor is Allan charging people for assets under management. And I don't know whether that's can be considered a conflict or not, but it's basically, here's my advice and pay by the hour. But so he's working with individuals these days, but he's been in the investment world for decades in both corporate and personal finance. Allan served as corporate finance officer of two multi-billion-dollar companies. That's another place where we should stop in his bio. You don't serve as a corporate financial officer of a multi-billion-dollar company unless you've got a whole lot on the ball. And Allan certainly does. And he's also consulted with many other companies while he was working for McKinsey and Company. Allan takes pride, this is what his bio says, in being mocked on a semi-regular basis by some financial professionals for his hourly fee model, and it's obvious that inability to make him rich. So at this point, Allan is trying to help you, not himself. He's also the author of How a Second Grader Beats Wall Street. That's a book that was republished, a second edition. It was first published by Wiley and Sons in 2009, and then again in 2011. And Allan writes for ARP, Financial Planning Magazine, and other outlets. He's taught finance and behavioral finance at the University of Denver, Colorado College, and the University of Colorado Springs. He currently lives in Colorado Springs. Despite his many credentials, he's got a CFP, a CPA, an MBA. Allan claims he can still keep investing simple. His professional goal is never to be confused with Jim Cramer. So Allan's got a sense of humor. He also has a BS from the University of Colorado, where he's magna cum laude. At Northwestern, You've got a BS from the University of Colorado, an MBA from Northwestern University from the Kellogg School, and then he's has a degree or certificate from an executive program at Stanford University Graduate School of Business. So Allan, welcome to Economics Matters, the podcast. It's a delight to have you. Really, really happy. I came across one of Allan's articles. I found it fascinating about laddering tips. So we'll talk about that later in this podcast. But I wanted to start off where I usually start, which is asking the guests to tell us how they got to where they are, starting with where they were born and how they decided to go down this path, because there's lots of younger people who are trying to decide what their career should be. And careers are kind of partly self-guided and partly accidental, and you kind of make your own breaks or just are lucky. So what happened? What's your story, Allan? What's the Allan Roth story?
I'd say 99.9% accidental and 0.1% planned.
Really?
But you really want me to start where I was born. Okay, I'm a native
Yeah.
Floridian.
Okay.
I went to University of Colorado at Boulder because it was number one in my field. It was the number one party school in the country at the time. It's gone way downhill since. But and I had taken a aptitude test in high school that said I should be an accountant. So I majored in accounting. I'm old. I went to work for one of the big 8 accounting firms. It's now KPMG in the Big Four. I did auditing for roughly 2 years. It seemed like 20, but it was only two. That was definitely not my calling in life. So I went back to grad school to get my MBA at Kellogg at Northwestern. For really greedy reasons, I wanted to learn how to beat the stock market. And instead, what's one of the first things you learn? Burton Malkiel's Random Walk Down Wall Street, not to do that. So anyways, after the business school, I wanted to go big companies, big oil and gas, and there was nothing bigger than Exxon at the time. So I did work for Exxon and a couple of very large companies. I got enticed to go to work for McKinsey Company, which was a lot of fun. I got to travel the world, all strategic consulting. It was a job that I never loved so much or hated so much, often in the same day. I loved it at 2 o'clock in the afternoon. I hated it at 2 o'clock in the morning. So it was a lot of travel, a lot of hard work, but it was fun, fascinating sorts of work. I went back to the corporate world, Kaiser Permanente and what's now Anthem, and got to be financial officers of both of those companies. So everything was going well until I hit my midlife crisis. My son was born. And I liked the corporate finance world, but it was never my natural habitat. So I had been very frugal my entire life, made good money, and I essentially retired in my mid-40s. And
Really?
to say that I failed retirement would be an understatement. I lasted less than a month. I had no passion that I didn't enjoy golf or other things. I had nothing to do with my time. So in a few weeks, I found myself starting to do some financial planning. And it was very easy for me to get the CFP because for some reason with a CPA, they allow you to challenge. So you don't even need to take the coursework. You can just sit down for the exam. And as I was starting to, why did I pick hourly? Well, every profession on earth is fee for service. Sorry for this really bad joke. You can edit it out, but even the oldest profession on earth is fee for service. So to continue to charge hourly, to build very simple portfolios. I'm a big believer in broad, cap-weighted index funds, and to continue to keep charging just didn't make any sense to me. Now, admittedly, if I were young early in my career, I could not have chosen that model. My first year, I had $500 worth of revenue. So I had a lot of time on my hands. So I was asked to teach at University of Colorado. I said, sure, that sounds like fun. The local Colorado Springs Business Journal said, we can't pay you, but you want to write a couple of columns for us? I said, sure. Next thing I knew, I was writing for Money magazine. And then that was really a fun column, by the way. The Money magazine was called The Mole. So it was an undercover column, not in my name, talking about some of the things to watch out for the financial services industry. So I may be the least popular. You mentioned Wade Pfau is the most popular person in the financial services industry. I may be the least popular. And by the way, advertisers or the advertising part of Money Magazine, they hated my column because advertisers didn't like some of the stuff that I was saying about various annuities and things like that. So the practice just kind of grew. I got busier than I ever planned to be. And that's where I am now. I'm really enjoying what I'm doing. The financial planning and the writing has just kind of taken off. Just as journalism was going downhill, I got asked more and more to write. So yeah, that's where I am today.
So do you have employees or are you one person show? How have you arranged it?
I am the sole financial planner.
Okay.
And to tell you why, in my corporate career, I was a really good analyst. And as an analyst, I got promoted into management, where I got to do some managing and some analysis. Then I got promoted into being officers, where I got to do no analysis whatsoever and all people management. And that was not my strength. That's not what got me out of bed in the morning. So I've been asked, for other people to join my firm and the like, and I'm just going to keep it the way it is.
I see.
If it ain't broke, don't fix it.
Got it. And so a typical client would be anybody, a poor person, middle class, like high income?
No, I've totally sold out. I started to help the middle class. The clients now probably average about a $15-20 million portfolio. In one case, I have, the client is in the billions.
Really? Okay.
Yeah.
And
And what I found over time is that the more fun engagements were the complex ones, helping them to move out of certain things that that had gated redemptions and tax implications and those sorts of things, which were really a lot of fun to analyze.
I see.
And then with my hourly model, I think for over a decade I've been at about 200 or 450 an hour, but I can't help anyone that has $100,000 portfolio on a cost-effective basis, unless I do it pro bono, which sometimes I do.
So is a lot of the work that you're doing for clients kind of tax related? How they're kind of sitting in a certain kind of a situation tax wise, and in terms of their investments, they have long-term capital gains, and they're not fully diversified. Is that a good part of the issue that you're trying to resolve for them?
Yeah, I would say really the business that I'm in on the portfolio is dealing with the complexities of moving towards simplicity. So yes, it's probably about 80% tax. Obviously, things in their tax deferred and tax-free Roth accounts, those are very simple, and getting the location there is very simple. But in the taxable account, things get to be very complex. Do you gift it to charity? Do you use a donor advised fund? Can you tax loss here to be able to get out of certain things there? What's the cost benefit of getting out of a very expensive fund that has a large taxable gain? Those sorts of things. That's what really takes the time. The complexities of moving towards simplicity. The tips ladder may be the one example, the exception where you create a little bit of complexities. And you're going to ask me about the tips ladder in a bit, right?
Yeah, I am. I wanted to see if we could take this, given your, you are working probably you are working for higher net worth people. What's your general approach? You're at a cocktail party, your neighbor comes up and says, I'm 55, I haven't saved enough. Here's how I'm invested. I want to retire at 62. What do you say to them? I mean, what's your general philosophy about investing? When you say you can take a 2-year-old and get them to beat Wall Street, expand on that?
Well, I mean, you've cut across a couple of things. Number one, you can be an incredible investor, but if you don't save, it doesn't matter. If I'm saving $10 a year, it doesn't matter how I invest. My only chance of becoming financially independent is to keep buying lotto tickets. So, issue number one is getting someone to save. And that's a very, very difficult thing. And one of the ahas that I had in my practice when I first started, and this was very early on, is people that came to me thinking they were in really good shape to retire soon had hardly saved a penny. People that said, I'll never be able to retire, had more than enough to retire. And by the way, I'm in that second category. Savers are pessimists, by the way, because we save because we're afraid of living under a bridge. So that causes, and our insula causes pain when we spend money. And some people have an active insula, get that feedback. Some people have an inactive insula. So people that haven't saved are generally more optimistic. They haven't learned to defer that immediate gratification. And I think that's very hard to change. I've never been able to, but if somebody comes to me and they've hardly saved anything, that they need a psychologist, not a financial planner, in my opinion.
So they're
So
going
in
to,
terms of those that have saved or near retirement, it's a combination of, taking risk off the table. As my friend William Bernstein puts it, when you've won the game, stop playing. Doesn't mean you get out of stocks completely. And I'm not a believer in 100% tips ladder. I think tips are an incredible tool that we'll talk about. But any one basket, as good a basket as it is, can go wrong. Government changes the way it measures inflation as one possibility.
or defaults on its debt, right?
Well, if the government defaults more than a technical default of a few days or weeks, I can't imagine the stock portion of the portfolio or anything is going to be worth much. And I don't think it's going to be gold. I don't think it's going to be Bitcoin.
That's
But
just Armageddon.
yeah,
So
does politics scare me? Absolutely. Is it a scary world right now with wars in different continents? Gosh, it sure is.
right. So a typical, let's say you have a 55-year-old person who has saved well, and would you be talking to them about when they're going to retire, and would you be talking about them what would you tell them about their portfolio? So some combination of tips and an index fund, would that be basically the advice?
Well, that could be the advice for part of it.
Okay.
But again, I'm not a believer in putting all your eggs in any one basket. So I think tips are wonderful right now with a real yield of about, I think, 2.6%. A 30-year tips ladder, I think I looked, was a 4.73% annual real adjusted for inflation withdrawal rate. That's absolutely amazing. But I wouldn't give up completely on nominal bonds. And I would want some of the upside of the stock market.
Right. Okay. So, treat nominal bonds basically as risky assets like the stock market, and not assume that they're somehow dominated by the stock market because of the inflation risk, because the stock market doesn't always respond well to inflation either. So we can't say for sure. But let's talk about this issue of, maybe you've got a 62-year-old who's just retired, and they have maybe $1 million or 500,000 or 2 million, and they want to, and Social Security is going to, give them some income. So my first advice would be, wait till 70 to take your Social Security, because it's going to be 76% higher. It's coming as an annuity. You're giving up 8 years of benefits, but those loss of benefits is really buying an inflation indexed annuity in the form of higher Social Security benefits. So that's the premium for the higher annuity. So, and this is the only place you can buy on such beautiful terms, inflation indexed annuities. And
you took the words right out of my mouth. Absolutely.
Yeah. Okay. Well, we're on the same page. But then the next thing would be taking the assets and figuring out how much you would propose a ladder of tips, and some part in risky assets, stocks, bonds, longer term bonds, commodities as well, or just you think the stock
No,
market?
I'm not a believer in. First of all, we cannot invest in commodities. I do not have an oil storage tank in my backyard.
I got it.
Well, all we can do is invest in commodity futures. And in the history of the futures market, in the aggregate, not a penny has ever been made before costs. So, I mean, think about it. If I buy a futures in oil, someone has to sell it to me. Remember when oil price turned negative? So futures are a wonderful thing. Now, Exxon was one of my first employers. And think about it, Exxon and Southwest Airlines. If they can trade oil futures, Southwest Airlines gets a major part of its cost structure normalized without volatility, and Exxon gets of their costs rather, and Exxon gets a major portion of their revenue stabilized. So the futures market is a wonderful thing.
But you're saying it's really just an insurance market as opposed to an investment market, is what you're
Absolutely.
claiming.
It's like betting on a football game. One of us is going to win, one of us is going to lose. The bookie is going to take the profit.
So if you want to invest in oil, you're really forced to invest in Exxon stock, and you might as well just be invested in the index then. Would
Yeah.
be the argument. Yeah, I see. So for the chunk of money so here's a person, he's got a chunk of money, he's retired. Some of it you're advocating be invested in tips, and the rest in risky stocks and bonds and index funds of both. Do you have maybe it'd be good to explain for everybody, first of all, what a TIPS is and what it stands for, and exactly how it works and how it's taxed, because that's a big risk associated with TIPS, and then how you would kind of what we'd like to do as an economist. We focus on what's called consumption smoothing, acting like a squirrel, trying to make sure that you have the same amount of acorns to eat, whether it's winter or summer or spring, autumn or fall. So consumption smoothing means having a stream of income that's inflation adjusted that continues really until you die. That's what you're looking for. Social Security does provide an annuity, real annuity, until you die. But it can't, for most people, it's not, that's not going to help handling their assets. And Social Security is not going to be everything they want to live on, because they experience a higher living standard than just what their Social Security benefit will be. So tell everybody about TIPS, the good, the bad, the ugly, and then the laddering idea.
Okay. And please feel free to fill in what I miss. But TIPS are Treasury Inflation Protected Securities. So a nominal treasury might pay a fixed yield of, let's say, 5%. A TIPS would pay a real yield of, let's say, 2.6% plus whatever inflation turns out to be. So in other words, in a nominal bond, if you earn 5% and inflation is 8%, that's not good. Your spending power goes down. With the TIPS, if inflation is higher than expected, your payout is going to be higher. So I argue, and I argue a lot, in fact, I'm the most argumentative person in the world, that TIPS are the least risky investment on the planet. Now, the market disagrees with me because in many ways, TIPS are more volatile than traditional treasuries. So with the TIPS, and the S stands for securities, so singular is still TIPS with a S, you're going to get paid a certain real amount, like 2.6%, plus whatever inflation turns out to be. So with the yield on TIPS right now, which 2 years ago were roughly minus 1.6%, so you're guaranteed to lose to inflation, it's a wonderful thing that you can not only protect against inflation, but you can grow with that inflation. Now, TIPS could have been issued in a very simple manner and taxed in a very simple manner, but the government chose not to do so. So the yield from the TIPS comes from two places. One, the CPIU, the Consumer Price Index Urban Adjustment, and that gets added to the value of the TIPS. And then the coupon, which is typically somewhere between as low as about 1/8% to roughly 1.5% or so. And that comes in the form of cash. But the government taxes us based on the total. So it's subject to what's called phantom income or phantom income tax. So the CPIU adjustment you don't get paid in cash. It gets added to the principal of the tips, but you still have to pay taxes on it, which is not the end of the world because it increases in value and it changes the cost basis of the tip. So it's more of a timing issue that you have to pay the taxes sooner rather than later. I don't like the fact that the phantom income tax is there, but it's also not the end of the world. So where do you locate the tip?
Yeah, let me see if I could say just what you said, but in slightly different words, because I think for people that aren't as familiar, it's always good to hear it two different ways. So if I, let's say, bought spent $1 million on 30-year tips, I could buy them in the secondary market or at auction, and let's say they're yielding, something like $25,000 a year as a coupon payment, because that's currently what the real yield is, roughly about 2.5%. So I get this, if there's never any inflation, I'm going to get $25,000 right out for the next, $25,000 for the next 30 years. Plus at the end, I'll get my $1 million back. And correct me if I'm wrong here, Alan, because you're the real expert. But then if inflation, let's say, was 10%, what I'll get is the 25,000, but then the value of my principal will go up. My $1 million at the very end they'll actually pay me $1,100,000 if it's a 10% inflation. But that extra $10,000 in income, because my wealth has gone up, my principal has gone up from $1 million to $1,100,000. So that's an increase in income. That's going to be subject to taxation right now, not when I receive the $1,100,000 in 30 years. So that's the notion of phantom income. You're paying taxes even before you get and then
the IRS. The IRS is going to tax you both on the 25,000 and the 100,000 CPIU adjustment. So you're going to owe taxes on 125,000 in that example.
Yeah, not 25,000. Okay, so that's not a good thing. That's the bad side of tips that you have to worry about. And then the other thing that you said in passing is that tips. If you bought a tip today, and let's say the real yield was 2.5%, and tomorrow it dropped, it rose to 5 percentage points real. So the market value of your tip would drop dramatically. This thing that was worth today $1 million would be worth maybe $500,000. That's the vol, and you might think, okay, this is a really scary investment because it could, like any bond, it could go up and down in price. On the other hand, when it drops down to 500,000, the yield would be up at 5%. So 5% times 500,000 will give you back the same $25,000. So the thing about tips is if you hold them to maturity, if you just keep holding this thing, you don't sell it, you're guaranteed to get this $25,000 stream. Ignoring, let's leave aside taxes for the moment. And the reason is that the end value after 30 years is pegged down. There's something that is unlike a stock that you could hold for 30 years. There's nothing that guarantees the terminal value, but with tips, there's something that does, and really with any nominal bond too, the terminal value is pegged. But here it's a real, you're going to get back 100,000, $1 million in real terms, in real dollars, in real hot dogs, in today's hot dogs, in 30 years. So that's why holding to maturity makes this thing completely safe, even though if you said, well, gee, this thing just dropped in half in its value, but one has to remember that the yield just went up by a factor of 2, so that the product of the two has stayed fixed. And so that's why when people buy tips in mutual funds, or they look at the return on mutual funds that are holding tips, there's lots of volatility and it doesn't look like such a hot investment. But you and I know, and we're trying to persuade everybody that the goal is not to be kind of at some point trying to beat the market. The goal is to kind of hold the market, in this case, hold the tips and just live off the income. And that's where we come to laddering, which is how do you actually get a steady stream? I mean, if the stream is 25,000 plus a million. That's not a steady stream of income. And if we want to get to a steady, stream, then that's where we have to do laddering. So, Allan, could you explain to everybody what laddering is about and
Sure, but let me just expand a little bit on what you said before. Right. If you buy that TIPS yielding 2.5% plus inflation, and the key is holding it to maturity, you're going to get that 2.5%, but you've got to have the courage to do nothing along the way, because you're going to see the value of that. If you buy that individual TIPS, you're going to see it go down if rates go from 2.5% to 5%. So you have to stick with it. And as you said, in a mutual fund or an ETF, you're subject to market risk. You don't know what your return is going to be. But if you buy the individual TIPS and hold it to maturity, you're going to get that return. Now, that's not to say that would it have been better to have bought it when the yield on TIPS went up to a 5% real yield, which I think is unlikely, but you never know. Sure, you would have been better off, but you and I know we can't predict those interest rates. I think I once asked you why the real yield surged so much, and I think your answer was it's a mystery, which is the exact perfect answer. None of us can predict rates, whether real or nominal. Okay. So to TIPS ladder, I've always been fascinated with what a safe spin rate. And I think I've mentioned I'm a pessimist. So I think the 4% rule, or I used to think the 4% rule was way too aggressive. So it was roughly, and I've been familiar with the TIPS ladder, which I think I first heard about it from your colleague, Professor Bodie. But when TIPS were yielding big negative yields, I had virtually no interest in something like that. But about a year ago, you could build a TIPS ladder, meaning a TIPS that matures this year, a TIPS that matures next year, et cetera, and going all 30 years, with the caveat that there are 6 years where you do not have TIPS that mature. So you have to kind of build the ladder around that by bunching the last year before the gap and the first year after the gap. As of today, you could build a 30-year TIPS ladder that would give you a 4.73% withdrawal rate over 30 years. So that means for $1 million, you can withdraw $47,300 a year, increasing every year with inflation. And
so it was $47,000, and that's what you can live off of, except for the tax issues. Yeah,
correct. The tax issues are real, so that has to be pre-tax. And by the way, there's one argument that says if you put it in the IRA, the traditional IRA or 401k, you at least don't have to worry about the phantom income tax. But there's another issue in that treasuries, whether they're TIPS or nominal, are state and local tax exempt. So if you live in a state like Florida or Texas, you get no benefit from that. You might as well put it in the tax deferred. If you live in California or New Jersey and are at a higher tax rate, there's an argument to go ahead and put it in the taxable account. But yes, pre-tax, you are guaranteed that $47,300 every year. In fact, you could do another, and basically what you're doing is building a ladder. And two good sites to go to, by the way, are tipsladder.com or ibonds.info, and it's EYE bonds.info, that have calculators in there to allow you to do it, because it's very complex. If you're trying to build that 47,300, some of it's going to be coming from the coupon, Some of it's going to be coming from the bonds that are mature that are also going to have the cumulative inflation already built in there. When you to build the TIPS ladder, you have to do it in the secondary market, like at a Fidelity or Vanguard or Schwab buying these TIPS from someone else. You've got to take all of that into account to try to approximate that 47,300 in that example.
Right. So now let's say people could read Allan's columns about laddering TIPS. Would they be available on your website?
No, I think actually, if you just Google my name, my parents gave me an unusual spelling, ALLANROTH, and TIPS. It's a combination. I've written about them in Advisor Perspective. I've written about them in ETF.com. I'm writing a piece right now for AARP on them. So they're in very different places. I don't write anything on my own website. They're all
out there,
media that pay me to write.
Okay, got you. So people can find Allan's writings about this, but now that you've got the TIPS set up, and but the TIPS are only 30 years at the max, right, in terms of duration. So if you're a 50-year-old, that's going to take you out to 80. How do you advise people to handle that?
Well, what you could do is something like, if you want to get a 4% safe spin rate, I think the math works out to be, you could put about 84% in the TIPS ladder, and then the other 16% in an ultra low cost broad stock index fund, or maybe two, one US and one international. I still believe in international. And then not touch the stock portion of it for 30 years to protect the longevity if you live longer than age 80, if you live longer than the 30 years. So that's one potential strategy or something like that.
Let me just comment on that this letting your stocks ride and is avoiding sequence of return risk, selling your stocks when the market is, let's say, doing poorly, and then having less money when the market rebounds and you've lost out. That's sequence of return risk. So you avoid that. But then the other thing that I would say as an economist, and we embed this in our we have this as part of our MaxiFi.com software called Upside Investing, is that we have people are buying a ladder of TIPS, like you're saying, but they're also not spending a penny out of their stocks. They're the Allan Roth, I don't want to say neurotic, but
go for it, say it.
paranoid, who thinks that this we should only spend out of safe stuff, out of stuff we actually have for sure. So that's what this upside investing implements. It has you spend nothing out of your risky stocks, which we treat as just the S&P 500 index. And then over the period that you say you're going to start withdrawing, every time you withdraw based on different Monte Carlo trajectories, whenever that withdrawal occurs, we assume the TIPS are being purchased, and that then you'll be able to raise your floor from that point on. So that's whether you're keeping the risky money off on the side and not spending out of it in order to have a pot of money for your kids, and it could be large or small depending on how well the market does, or whether you're doing it to have upside spending power for your retirement. The strategy is really the same, not to spend out of it, and just to spend out of your TIPS. So we're definitely on exactly the same page. We implemented upside investing about 2 years ago, and the interesting thing, Allan, that I want to point out to you is that in looking at somebody like, a 50-year-old, even a 60-year-old who wants to implement this strategy is that they could put relatively little of their assets in stock and still have a very healthy upside. Maybe 20 years later when they say they'll start withdrawing at that point and converting into safe assets, you don't need a lot of money in the stock market to have a lot of upside, provided you don't, let the thing ride. And letting it ride also means not looking at it, treating it as money in the casino and not being tempted to say, well, I got all this money in the stock market. Now I can therefore go on a vacation I would not otherwise have taken. The discipline of this upside investing is to treat that money as completely lost, you're inside the casino, you're gambling, and you don't spend your winnings until you actually have them and you've left the casino. So just, what's your reaction to that? Are we on the...
Yeah, no, that's exactly it. And there's a couple of behavioral things about these tips and the tips ladder. Number one is, I've always said, a bad sign on investing is something that feels good. And something that feels bad is typically a good thing. So when stocks dropped, let's say, when COVID hit in 2020, between February 19th and March 23rd, stocks dropped 35% in 33 days. And of course, I had to rebalance, which meant I had to buy stocks, which was the most painful thing in the world. I mean, it was really, really hard. It would have felt so much better to have gotten out. These tips are the one exception of something that both feels good and makes incredible economic sense.
So in what sense, why did you had to rebalance between stocks and bonds and real estate and foreign stocks? Is that what you mean by rebalancing?
Between stocks and bonds.
Okay.
So I had to sell my bonds, which, did act as a shock absorber, unlike last year, and buy more stocks. At the same time that our lives had dramatically changed, we were no longer going out wearing masks. The vaccines were just a pipe dream back then. So it was a very, very difficult thing to do. So I am absolutely a believer in rebalancing. That's one of the areas of market timing. Another area of market timing, I wrote about this 13 years ago, areas that I'm an active investor, and one of them was tips. When tips had a negative yield of 1.6%, I had very minimal amount, and those were in tips funds. Now that tips are yielding 2.6%, I have a lot more in tips, and I believe in the individual tips rather than the funds, with the possible exception of the BlackRock. These are brand new defined maturity ETFs.
Right. There's
tips ETFs.
Allan wrote recently and sent me his column about this, that BlackRock is selling tips that just pay off the principal, no coupon payment along the way at a given date between 1 and 10 years, right?
Yeah. They actually pay out the whole thing.
Oh, okay.
They get rid of the phantom income tax issue by distributing both the CPIU adjustment and the coupon. Now, it's really easy on the tips ladder. If I use those funds, I just have the whole thing reinvest, both the coupon portion and the CPIU. And the math is really easy, because all you have to do is, if I was going to buy a tips that was going to mature in 5 years, a tips ETF, and it's yielding 2.6%, I can just take, if I wanted $1,000 divided by 1.026 to the fifth power, how much you have to buy. So it simplifies everything, but you also pick up a fee, a 10 basis point annualized fee.
Right. So now let me ask you a question about the non-tips assets. You said that you can basically get commodities by buying Exxon through a index fund. Can you get foreign investment, enough foreign investment diversification by just buying the S&P or a broader U.S. index of stocks, because so much of U.S. corporate investment is abroad? Is that sufficient, or do you think that's insufficient?
I think that's insufficient. And, I was really lucky in my career. I got to meet and talk to Jack Bogle many, many times. The first time, by the way, was just sending him a blind letter saying, I'd love to meet you. And a week later, getting a card, I'm coming to Colorado in a month, let's get together. And that was one of the first, because, Jack Bogle, being right after his passing.
Tell everybody who Jack Bogle was.
I'm sorry. Jack Bogle was the founder of Vanguard, and really the father of the first index mutual fund, the S&P 500 index fund that he launched in 1975. But he has generally not been a believer in international. And his arguments were that you had enough. And let me just say, I'm wrong. He's right. International has long underperformed, and maybe I'm stubborn and still believing in diversifying. But his argument was that the S&P 500 had enough 40% exposure. And the second argument was that, countries like France and Japan, they have a lot of problems. And my counter to him was that if you had enough diversification, you wouldn't see such extreme differences in performance between US and international. And those problems overseas are known to the market, and the reason why they've underperformed. I would argue now the reason why international is underperforming is look what's going on in the Middle East, look what's going on in Ukraine, possibility of China and Taiwan. It's a very risky world. But, in my belief, you wouldn't only invest in companies that are based in Massachusetts. I wouldn't only invest in companies that are based in Colorado. I once joked at a forum with Jack Bogle sitting a few feet from me, saying, "Look, if I could invest in stocks and companies in other planets, I'd do that too. Jack, can you launch the first intergalactic index fund?"
Got it.
So I'm a believer in diversification. You do not get enough, in my opinion, international exposure by buying the S&P 500 or a total U.S. stock index fund.
What about real estate? Do you get enough, or should you be buying separate REITs indices? And what would all these kind of percentages be in your risky portfolio?
Well, I first of all, a private REIT that pays a commission, avoid those things like the plague. But a REIT index fund, I think, can make a lot of sense. Now, the REITs are also owned by a total stock index fund. But if you look at, global wealth or national wealth, most of the value of real estate are not in public markets. And the correlations between REITs and the stock market are low, but not negative. So you do get some diversification. So I'm absolutely fine if somebody, wants to own a little bit of a REIT index fund, but I would generally keep it less than 5% of the equity portion of the portfolio. You're overweighting it, but you're overweighting it to more mimic national wealth rather than you think it's going to outperform.
And what percentage would you put into a foreign index? And would these be emerging country indices, or would they just be some general index of what's your favorite foreign index?
Total International Stock Index Fund.
From Vanguard, okay.
Vanguard, what's it? I can't think of the iShares has a very good one, but just something that is very broad. You can own over 7,000 companies in a total international stock index fund, and nearly 4,000 companies in the total U.S. stock index fund. And, for the longest time, people were saying, don't buy a cap weighted, smart beta, small cap value, etc. And guess what? Small cap. I was at a conference I don't know, 13, 14, 15 years ago. And I couldn't go for more than 5 minutes without hearing the term smart beta. That was a warning sign. Look what has been the drivers of return, the large cap growth tech companies. For a while, almost the entire return of the US stock market this year came from the Fantastic Seven stocks.
The biggest tech companies, they've done quite well, and they've brought up or kept the value of the S&P from plunging, I guess, significantly. So, any parting thoughts on investing? You're saying that a 2-year-old can beat Wall Street by.
He was a second grader. He was 8 years old.
Sorry, second grade.
Why my son?
An 8-year-old.
Now he's 26 now, so he's lost a lot of his advantages because the older we get, the more money means to us, and the more emotional mistakes that we make.
So, I would agree with you. I find it remarkable that we have this software that is really fantastically powerful for helping people make all kinds of life cycle decisions, whether or not they can afford to get divorced, whether they should take this career, switch jobs. If they retire this age, how much will it impact their living standard versus this age, when to take Social Security, all these things. And I have a department of, about 35 other economists, and the number that are using this tool, which is perfectly free because Boston University provides it for free, I think about 5 people, 5 economists. They all think they're doing it right, or they're all afraid. I'm not sure whether it's fear or pride that's their problem. What do you think might be the case? I mean, what's your sense?
I don't know what this is a myth or whether it's true, but Harry Markowitz, the founder of
Sure.
Efficient Frontier, I think he was once asked, well, how did you design your portfolio? And his answer was 50-50. Why? To minimize regret. So, I will tell you, I have some clients that are really world-renowned in the world of behavioral finance. And understanding the theory and actually implementing are 2 very, very different things.
Right. And by the way, just to connect our discussion about upside investing or putting a floor to your living standard with the TIPS ladder, and then having upside either for a bequest or for future higher spending power, upside spending power. This really does connect to behavioral finance, because the one thing people don't want to do is see or have happen is have their living standard decline dramatically in retirement. That's really what they're most afraid of. And so they've gotten used to it. They've gotten addicted to their prior living standard, and having it decline is a major loss. So that's why this tip strategy is really feeding into that behavioral instinct, the instinct of the squirrel. It's not like it's bad behavior or screwed up behavior. It's just natural behavior, and none of us want to see our living standards decline, because we will be, I guess we'll just remember how things were, and we'll be very upset. So having just upside risk is a good thing. But
there's a second behavioral reason as well. And remember, I mentioned that savers are pessimists,
right?
And we're always afraid to spend. So, my insula trained me to live frugally. And all of my clients are essentially in that same category. And helping them spend money is a very, very difficult thing that I can relate to. I wrote a piece not too long ago, how to help clients spend more money. And the TIPS ladder, along with Social Security, for me, gave a 6-figure floor, knowing that if things got really bad, we own our own home, we don't have a mortgage, we could live that way. And it was kind of as David Blanchett, I think you interviewed him, didn't you?
Mhm.
As he put it, it's a license to spend.
Yeah. Yeah.
So
David.
that allows me to be a little bit less frugal, along with some other strategies like reframing an expense
Right.
as helping live longer, helping safety, those sorts of things, versus having a fancy Tesla sports car,
Yeah,
more
absolutely.
safe.
I think that's great insight. You don't want to worry about having your living standard drop, but if you don't want to be so worried that, but here's a way you can arrange to spend and not have to worry about that. But that does give you a license to spend, which, yeah. So, Allan, this has been terrific. I really appreciate your coming on. We're going to stay in closer touch going forward and have you back. And hopefully, uh, people will listen carefully and take your very good advice. So thank you once again.
It's been my pleasure. Thank you so much, Larry.